Hello again, and welcome to another episode of the Uranium Market Minute. Today is Wednesday, August 20th, and this is episode number 211. My name is Justin Huhn. I am your host. I'm the founder and publisher of the Uranium Insider Investing Newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. As always, nothing that you see or hear in this podcast is intended to be investing advice. I'm not your financial advisor, and this is not financial advice. Please always do your own due diligence when it comes to investing and always take responsibility for your own choices. All right, it's great to be back with you again today. I want to talk about the long-term contracting market. This is a market that is not very well understood by investors, and it's something that I think we need to discuss because it'll not only help explain the dynamic that we've seen in the term market and the term pricing dynamic over the past year and a half, but we'll explain what's coming and what's ahead of us. And that's very, very important from an investing perspective. Before we dive into it, I want to remind you we have a free report, The Case for Uranium. It's a free download, it's in the description. This is our take on the thesis for being long this sector right now. We believe that this is a very, very exciting and constructive setup right now for many of the reasons I'm going to talk about in this episode. So let's dive into it. First of all, what is the long-term contracting market? So the spot market and the term market are two separate markets within the same market, right? And they're inextricably linked by traders and trading activity. The spot market is for settlement of less than 12 months, and most of the time it's front month or possibly 2 months forward settlement. This is a market where you have producers and traders oftentimes having a little bit of excess and they go ahead and sell on the market to raise some cash. Most of the sales pressure coming into the spot market is coming from traders with offtakes from producers. And the primary one is out of Uzbekistan. That is the primary source of volume in the spot market. But we do know there's a number of other entities that do sell on occasion in the spot market. Typically, on a monthly basis, we'll see 2.5 to 3 million pounds of uranium from primary sources sold into the spot market. And there's not a lot of inventories out there for sale any longer. So most of the spot market sales are coming from primary production via offtakes with traders. It is a surplus disposal market. It is a market where hedge funds will do some buying and selling. You'll have traders oftentimes trading pounds back and forth, and pounds back and forth being traded is usually the bulk of the volume in the spot market. This year, that's been a little bit different. This year, the majority of the volume has actually come from utilities. This is utilities buying in the spot market when the price was very low, when we had the price drop into the 60s, March and April. And then you also had a number of carry trades get done. So this is utility demand in the midterm that traders will fulfill rather than utilities signing a contract with Cameco or Kazatomprom or whoever it might be. They put out an RFP or have a conversation directly with the trader. They want to get 200,000 or 300,000 pounds delivered 2, 3, 4, 5 years out. The trader calculates their cost of carry, their cost of capital, their profit margin. They go ahead and buy in the spot market to fulfill that. That's a carry trade. That happens anytime you see a wide contango in the market. So the front month or the spot price is significantly lower than the midterm price. So right now we're at about 72, 73 spot, mid 80s would be probably the midterm price, somewhere in that ballpark. Not a lot of carry trade activity happening right now until and unless the spot price drops or the midterm price in the market goes significantly higher. And that could very well happen, right? Now, the spot market also is the market where you have the most transparent price reporting. You have prices reported by multiple entities on a daily basis. Most of those entities are behind paywalls, but you do have free sources of spot uranium price reporting daily. Now, that's what the investors can see. Now, unfortunately, the long-term price, the pricing across the fuel cycle is something that most investors don't have access to. Of course, members of Uranium Insider do, and we do, and those numbers are shared with our membership, and that's important to understand what's going on in the rest of the fuel cycle, especially in the term market. And we also put out a uranium market report on a weekly basis that goes deep into what exactly is happening in the term and spot markets. Most important thing to understand if you're long this sector or want to be long this sector, what is going on in the physical market. Okay, so transparent price reporting, usually smaller volumes, although this year it's been higher on behalf of utilities in the spot market. You have significantly more, let's say, manipulation of price. It's not a huge amount, but oftentimes you'll have traders trying to knock the price down at the end of the month because their next month offtake is priced at the month end, right? So that can happen. Oftentimes you'll see the price move significantly on low volume. So when spot was buying a couple months back and the price pushed up to about 78 bucks a pound, the move from 78 back down to 72 was essentially on 200,000 pounds of uranium from one trader. So that's how significantly this market can move on very low volumes. The long-term contracting market is for settlement anything beyond 12 months. This is also where utilities will procure the bulk of their uranium that will eventually become nuclear fuel. Now, even though it's beyond 12 months, most of the term market transactions go out a little bit further into the future. So 2 years, 3 years, and then when you're a utility trying to procure and sign large long-term contracts for future delivery, typically you're looking out 3 to 10 years. And most of the RFPs and tenders that are in the market right now are for that 2027 to 2033 period. And that is pretty typical, actually. This industry sort of lives in the future. So when you see utility coverage for the near term, that never really means anything because they're always covered for the near term, because you have a 2 to 3 year fuel cycle that uranium has to go through to become fabricated fuel and get delivered back to your facility. So near term coverage is not anything special or new. It always is there. When you start to look out 3, 4, 5, 6 years and see the enormous amount of uncovered utility demand that is yet to cover, that tells you what's coming because it has to. Now, Justin, if it has to, how are they able to sign only 42 million pounds in long-term contracts this year and insufficient number of pounds last year relative to replacement rates? Well, there's elements of the contracts that I want to talk about that I think need to be addressed and understood more widely. So typically a contract request, a tender, an RFP in the market will say, I need this many pounds delivered per year for this many years. What do you got? Now, we just recently saw a tender coming from the Koreans, the Korea Hydronuclear Power, that is operating a little bit differently, and they are sort of anomalous in this sector, right? So they'll come out and say, we need this many pounds. These are the years we need delivered, and this is what we're willing to pay. So the tender that's out there right now from the Koreans, this is coming about 2 weeks ago, this came out, which is early, by the way. Usually it's September, October for the Koreans RFP, so it's a little bit early August. And there's actually a lot of activity for August, which is, in our estimation, a tell of what's about to happen. Okay, the Koreans, they're looking for 8.8 million pounds of uranium delivered over a 10-year period, 2027 to 2036. So 880,000 pounds per year for 10 years. What they are willing to pay is for the market reference portion of the contract, which they are asking is 70%, would be market reference, 30% base escalated. 70% market reference, floors no higher than 65, ceilings no higher than $101 a pound. Now, if you've listened to us, if you've listened to multiple other people, including Cameco and Grant Isaac, speaking in their conference calls, basically what the primary producers of the world right now are wanting from their buyers is floors in the 70s, ceilings $120 to $140 escalated. So $140 escalated 10 years from now at a 4% escalation rate, compound annual, that's $200 a pound that they would be receiving for a delivery in 2036. So this contract request, this tender that the Koreans put out, in our estimation and in the estimation of many other industry colleagues, this is not really in line with the current pricing environment in this market. We're seeing small volumes get done, carry trades, base escalated a little bit, that is starting to taper off. Then we're seeing market reference, and what Cameco is saying, if you want to sign a multi-million pound contract going out late decade and beyond, this is what you're going to have to pay. And utilities are like, yeah, we're not doing that. So in the meantime, we're starting to see utilities come around. And over the past year and a half, 2 years, even a little bit beyond, what has been happening that has been allowing utilities to avoid the term market in size? Well, there's other elements to these contracts besides time period and price and volume. The other elements of these contracts oftentimes are flexibilities. These are quantity flexibilities and time frame flexibilities. And flexibilities in the contracts are something that sellers would offer to their utility buyers during a period where it was much more of a buyer's market. The price was lower. Oftentimes there was bearish action in U308, and the utility would offer these flexibilities. So what do these look like? Well, according to UXC, using 2020 as an example, you had quantity flexibilities sometimes up to and even breaching 30%. So what that means is a utility signing a contract in 2020, and let's say they have delivery this year, 2025. amongst the years in the contract. And let's say that that contract was 50% fixed price, 50% reference to the market. Well, the 50% reference to the market is going to be some kind of multi-month average of the spot price prior to the date of delivery. So if we go back 3 months from being delivered today, they're probably going to pay $71 a pound or something like that, right? For that portion of the contract. But the 50% that was fixed at the term pricing in the contract in 2020. And what was the term price back then? $35 a pound off the top of my head. Maybe they paid up to $40 fixed in 2020. So if they have the option to receive 30% more material than was dictated in that contract and have that pricing 50% at a price that's basically half of the market price now, they're going to do that all day long, and they have. So every single contract that was signed between a utility and a producer, 2018, 19, 20, even 2021, that has been delivered upon in the last 2 years, and even currently, that had flex provisions, quantity flex provisions especially, they have been flexed up on. And that has done two primary things. That has allowed utilities to generally avoid entering the market right now in size because they've been able to flex up on all these legacy contract deliveries. And two, it has significantly tightened the near and midterm as far as what producers have on offer. So if you're a utility and you have to cover for 2027 or 2028, and you have to do it in a decent size, you're in for a shocking reality. The producers are going to be demanding significantly higher prices than you were expecting to pay. And that is what is coming in front of us. So time flexibilities also would allow a utility to accelerate or delay the delivery of uranium. And obviously over the past few years, especially with the significantly higher pricing and tight markets for conversion and enrichment, those deliveries have been accelerated when those flex provisions were in those contracts. So the flexing up is not only something that highlights as an example of a buyer's market, because this is something that utilities want. If they have flexibility, that's fantastic for them. They can get more, they can get less. And the opposite was true during the bear market, right? If you signed a contract back in 2010 for $60 a pound, and then you had that delivery 4 years later and it was $45 a pound, you could flex down in quantity. You could even delay that delivery, right? So you would flex down in quantity, buy in the spot market to short up. So the flex provisions are something that utilities love. And importantly, now that we have shifted into a seller's market, especially over the past few years, but especially right now, those flex provisions are largely gone. So very few contracts under discussion have quantity flexibility. So that's the environment that we're right now. So if you can picture the previous legacy contracts signed late 2010s into the early 2020s that had these different provisions. Those are all winding down. They're coming off as they get delivered into. And we get into this environment where taking deliveries next year in 2027, 2028, you go out late decade, those deliveries are going to have zero flex provisions because these contracts that were signed last year, the year before, and especially right now, very little, if any, flex provisions for quantity. So that is one element of this very complex market that adds some flex is the quantities in these contracts. The other flex that utilities have had over the past decade and a half is abundant above ground mobile inventories, abundant secondary supplies. Both of those things are largely gone. Okay, the above ground mobile inventories are essentially gone. The forward reliance on the industry for pounds in the market to procure is going to have to come out of the ground from existing or even more concerning greenfield projects that haven't been built yet. And that's where we're at currently. So how well are utilities covered right now and what is coming? So this screenshot is from Yellowcake PLC's investor presentation. They update this pretty frequently and there's always some very compelling graphics and information there. I strongly suggest that you check that out. Yellowcake PLC is a physical uranium fund based in the London Stock Exchange. So this is highlighting the US utilities and the EU utilities, which make up about 54% of global uranium, of global nuclear capacity between the EU and the US. Now, the EU is typically better covered than the US, as is represented in this graphic. Usually EU utilities will have on average about 3 years of material. Usually the United States has about 2 years of material. And you can see currently 2005, 2025, 2026, 2027, pretty well covered. Surprisingly, the minimum coverage in the EU 2027 is only 75%. So 25% of that 900 gigawatts or whatever it is still has to be covered. You go out late decade, and by the way, producers have minimal available pounds. 2027, 2028 gets a little bit better late decade, but 55% of the US utilities are covered, so 45% are not in 2029. And that drops off a cliff. And you go out into the early 2030s, and this is a very, very concerning picture. Now, what about the rest of the world, right? Okay, the Indians, they generally have fuel coming from Russia. The Chinese are pretty well covered. South Koreans and the Japanese are two very large markets that have less coverage than the EU, right? So they've got coverage probably pretty similar somewhere around the lines of the EU and the US, the Japanese and the Koreans. And they're both, the Koreans are already in the market. The Japanese have some contracting to do. So while this only captures a little more than half of the global capacity, or the global demand, I should say, you can get a decent idea of this picture. So look at all the uranium that has to be covered by the United States by 2031. This is an enormous, enormous amount of uranium. And who is going to have that available? Now, we've already seen multiple utilities signing contracts with NextGen. NextGen is saying they're going to have first production in 2030, right? So they expect a 48-month development timeline following their final permitting, which could come towards the Q2 of next year. 48 months from that would be mid 2030 first ramp up. So first cake in a can, realistically, if everything goes absolutely perfect and smoothly, would be 2031 from NextGen's Arrow. Now, people that are much smarter than us, who are mine engineers, who have done an enormous amount, I'm talking tens of thousands of hours of work in this sector, don't believe there's a snowball's chance in hell that first cake in a can comes in 2031 for this extremely large project, right? According to their feasibility study, it's the largest uranium mine and mill ever built. They're talking about 29 million pounds a year starting in 2031. So any delays to that is going to send shockwaves throughout this industry because it's so unbelievably important that these greenfield mines that haven't put a shovel in the ground yet are producing on time for this to not get away from them. And that's a real concern here. So I mainly wanted to share this with you guys because while the near-term coverage is always there, look how concerning the coverage is. And this is the time period that they're trying to cover, 2027 to 2033, that they're trying to cover. And you go out to 2033 and you have barely any coverage whatsoever in the United States. And this, while it seems like it's a very long time from now, this is when the utilities are trying to cover for. So they're buying out into the future during a period that is going to be unbelievably reliant on projects that don't exist yet. And I want to make this point because it's really, really important. This is new territory for this industry. So never before have they entered into the early stages of a contracting cycle. That is to say, when they intend to come to market in volumes that at least approach replacement rates, because all of the levers that they've been able to pull are sort of running out, while there is an undersupplied market that is highly, highly reliant on projects that literally haven't been constructed yet. This is brand new territory. And the massive bull market that we had 04 to 07, of course, was along with every other commodity at the time. But that huge bull market that went from $10 a pound to 134, that was during a structurally balanced market. You had the Chinese are buying a lot, and you had mine disruptions with Cigar Lake being developed and flooding on two occasions. You had financialization, you had hedge funds buying uranium, et cetera, and it turned into a mania that went up and came down just as fast as it went up. This is a very, very different market. During the previous bull market, what else did they have? Very large amounts of secondary supplies. This was not only coming from tails reenrichment and underfeeding, but importantly from megatons to megawatts. That was 22 million pounds a year for 20 years, coming from Russian warhead downblending that was feeding into the US market. And I'll show you that on the next slide. The secondary supply is a buffer. It buffers any disruptions for mine development. And we don't have that here. It's very, very small. The Western enrichers are not underfeeding or re-enriching tails at all, at all. Urenco and Orano, it's 40% of global enrichment capacity, and they're not doing any underfeeding at all. The Chinese are not either. They're filling into a huge amount of demand from their massive reactor build-out program. The Russians are doing a little bit of underfeeding, but not that much either. Demand for their enrichment has actually maintained in this environment, even though the West has not engaged in a lot of new business with Russia. They have plenty of demand coming from China and from India. Okay, so Now we're leading into this environment where we know we have massive uncovered needs. So, what are the numbers from UXC? More than 400 million pounds need to be signed between now and 2030, and more than 2 billion pounds are uncovered out to 2040. And there's a very important detail with this. UXC's modeling for those numbers come from existing reactors that they know will be operating out to that time frame, reactors under construction that are expected to hit the grid during that time frame. It is not including any not officially announced life extensions for operating reactors. And we know there's going to be a slew of them in the US and in France that, as of now, are still modeled to shut down. It also doesn't include new builds that have not started yet. So that could be, even in the Western world, we could see new builds started in the next 1 or 2 or 3 years that are operational before 2040. What about China? They're building reactors in 5 years. So anything that isn't under construction right now is not included in that 2 billion pound uncovered number out to 2040. So, and UXC highlighted this in their article, right? They're saying one of the reasons that producers are holding out with their terms like Cameco and saying Cameco's holding the line with 70s, 80s floors, 120 to 140 ceilings, and the other big producers seemingly are doing the same thing. Why are they doing this? They know that there is a lot of utility demand that is going to come into the market very soon. So that is what UXC is highlighting. This next slide just shows you the secondary supply situation. And that big light blue bar back in 2013, that was the last year of deliveries from megatons to megawatts. Then we had a huge amount of tails re-enrichment and underfeeding during the 20 teens. Why? Demand came offline in a big way, right? Japan shut in all the reactors, Germany shut in a handful and had a plan to. So demand for enrichment dropped off a cliff, but the enrichers, they've got these centrifuges, they can generally keep them operating at all times rather than shutting them down. So with that excess capacity, they can take tails material and re-enrich it to natural UF6 at 0.7 U235 and sell that into the market as UF6. That's tails re-enrichment. Underfeeding is the contracts that they signed for enrichment were at a tails assay higher than what they can operate, and they can generally operate at lower tails when the demand drops off. So they actually use less of the feedstock provided to them by their utility customer. They underfeed the centrifuge and sell the excess into the market. How is that going? Look at that gray bar and how it's dwindled over the years. Especially significantly dropped off according to Mindspan, which is the source of this data this year. Now, I would argue that 2023 even had less than what they're modeling out there at 20 million pounds of secondary. But the Western enrichers are not underfeeding whatsoever, and they're modeling underfeeding to disappear by 2035, which I think is very interesting. So they're probably modeling that demand is going to outpace expansion of enrichment out to that time frame, and it very well could, right? Then you have reprocessed uranium and MOX fuel. MOX is not set to grow basically at all. The Japanese are building a small facility. The French are the only ones that really use it. It's expensive. It involves handling plutonium, so people don't really like to engage in that activity. Reprocessed uranium, yeah, that could be a thing going into the future to fuel some advanced reactor designs for SMRs, but right now, not a really big deal. So this is just a visual representation of the lack of secondary supply buffer. So secondary supplies have dwindled, above ground mobile inventories have dwindled. Demand is de-risked almost on a weekly basis. We see some news story about a reactor life extensions. We are updating our models on a weekly basis. That's how often the news is coming in that is de-risking the operating fleet of the world, especially in countries that are seeing drastic expansion in electricity consumption. So that would be let's say the expansion of the middle class in India. That would be any countries that are operating large data centers and have massive data center and AI growth. And of course, electrification of everything here, of transport, eating, of cooking, et cetera, et cetera, et cetera. So the fleet is being de-risked. Demand is being de-risked. The supply side looks essentially more concerning than ever. And we are coming to a point where most of the brownfield projects of the world that were easy to restart have been restarted. And almost all of those have run into some problems. So we don't have enough greenfield expansion. We're going to need to see higher prices in order to see that happen. And when it does happen, any delays in the development of these large greenfield projects is going to have big reverberations in the physical market. And this is one of those things that I'm always saying is like, you don't have to know what is going to disrupt the market. You just have to be able to recognize that the market is ripe for disruption And this market is, it absolutely is. Lastly, I just want to highlight the seasonal element of this trade and of this industry. This is something that on average takes place on an annual basis for reasons that are pretty obvious. The summertime is very slow. Come back from summer vacations and fuel buyers attend the World Nuclear Association Symposium, which happens the first week of September. It's happening in a couple of weeks. I will be there. They meet with producers, they meet with traders, they talk, they come back to their desks in September. Many utilities get new budgets early Q4, and then you make decisions on procurement based on your budget, based on the pricing regime that you understand from talking to your cohort. So usually, and this is the Sprott Physical Uranium Trust, and this is a 19-year average. And yes, SPUT has only existed for 4 years, but they took over UPC. So this is taking Uranium Participation Corporation into account as well. And you can see usually a big move mid-August to mid-September, followed by a much larger move early October into late February. And that's the average. Okay, it doesn't happen every year. But why do we think it's probably going to happen this year? All the reasons I already mentioned. We're coming towards the tail end of a long period of stagnation, where the price has not moved that much, where you even have the price reporters telling their utility customers, guys, that $80 term price that we printed last month isn't telling the whole story. We have a situation here. A lot of demand is coming, and the price is going to be moving higher. And when UXC said this last week, they didn't hedge at all. Okay. They didn't say maybe there's some hidden supply that's going to come in from here or there. And most of the time, they make any sort of quote unquote bullish price predictions, which isn't often. But in the past, as far as the last 5 years that we've been reading this material, they always hedge. Maybe this will happen, maybe that'll happen, but generally speaking, it's looking like it's going here. No, now they're coming out and saying, we've got 2 billion pounds uncovered out to 2040, 400 million pounds out to 2030. The producers are telling you that the production availability out to the late decade is tight because they've been flexed the heck up on for the last 3 years. And the supply that has to come to fulfill that demand gap hasn't even been built yet. So prices are heading higher. Deal with it. That's essentially what they're saying. Okay, I'm paraphrasing. So long period of stagnation, even the price reporters are banging the drum here. And now we're leading into what is typically a strong season. And importantly, what is the evidence right now in the physical market? The evidence is a bunch of utilities have small RFPs and the Koreans have a big boy in there right now in August. This usually doesn't happen in August. So to us, that's a big tell. And of course, to wrap this all up in what should be obvious, only uranium is going to fuel these reactors. And the reactors is a multi-billion-dollar strategic asset, especially right now, and especially in environments currently where data centers are growing so quickly. These utilities are operating in an environment where they're raking in record profits. Okay. So they understand the record profits. They understand there was just a power auction last month in Pennsylvania that was also at record prices. So this is a environment that they've never seen before that they're producing into. They're going to buy what they need to buy when they need to buy it, regardless of where the price is. Now, they've been able to pull on different levers kind of up until now. They've been able to flex up. They've been able to buy a little bit of spot. They've been able to buy a little EUP. These are small volumes. The flex is the biggest volume of all of that. Those options are declining, and we're going into an environment where the deliveries will not have quantity flexibility options, where there is insufficient secondary supply, where there is no real above ground mobile inventory buffer, and the pounds that they're going to be buying have to come out of the ground largely from projects that haven't been built yet. It's an unbelievable setup. Okay, gonna look at the charts really quickly because this went way longer than I was expecting, and then we are going to sign off for the day. Starting off with URA, still got an hour left of trading as I record this. Pulled back significantly yesterday. Yesterday looked like a momentum unwind. There's a couple of news stories that came through. One, concerns in the investing community about a peace deal with Russia. This is completely misinformed. A, we pray for a peace deal. B, the United States and the EU have continued to take deliveries of Russian material all throughout the extent of this conflict. And starting January 1, 2028, it is illegal for the US to bring Russian material into the United States. Period. That is law. So that doesn't go away with a peace deal. That goes away only with legislation that opens Russia back up to the US. So starting January 1, nothing else is coming in from Russia into the United States unless that law is changed. And that would have to be written up That would have to pass the House, that would have to pass the Senate and get the the president's signature. And if you understand the sort of pro-America effort that Trump administration and Chris Wright are making, especially in terms of energy, it is highly, highly unlikely that that will happen. So the sell-off, if it was at all inspired by concerns about a peace deal, 100% misinformed. In fact, I believe it's a net positive. Why? We could have reactors restart in Ukraine, which is demand. The largest European reactor is in South Ukraine. That's the Zaporizhia plant. It's now under Russian occupation. But if that is restarted, that's a lot of demand. And B, just clarity around all of this mess helps utilities to make long-term decisions. So we hope that that is the case. The other thing that was spinning around yesterday was an announcement that the Catco joint venture in Kazakhstan was going to increase production. They're trying to get Catco up to 4,000 tons a year, which would be 10 million pounds, about 4 million pounds at what it's going to produce this year. If they accomplish that, that won't even replace Somer that the French just lost in Niger, which was north of 5 million pounds a year. And that's done, at least as of now, especially for the French. So Orano doesn't have that production. And Orano is only 51% of CAC. So they're only going to get half of that increased production. It's a non-story. I think this was mainly a momentum unwind. With all of that said, we still could go further down according to RSI, and we don't really see any levels of support or resistance here down until about 33 and a half, 34 URA, which would be only another, what, 8 or 10% down, maybe less than that. You went down to that level, 6% down. That's one bad day or a couple of kind of uncomfortable days. That would be an outcome to be devoutly wished. If you want to be long or get longer before we come into the WNA and the expected strong season, and that is just a near-term expectation. What we're looking at here really is the next 12, 18, 24 months should be extremely constructive for the uranium space and the uranium price. Generally speaking, the equities will move with price because it is a commodity trade. Cameco has been the lead sled dog for some time. It's the one-stop shop. This has similar levels of previous resistance that could be support, maybe down here around 62. That would be a decent sized drop from here. Maybe we see it, maybe we don't. The S&P has remained relatively strong. It's rolling over a little bit here. And of course, here the S&P is basically just off of all-time highs and is at valuations that are very, very close to the dot-com bubble type levels of valuations as far as price to earnings. And we have a little bit of negative divergence with RSI. So I would not be surprised to see this pull back significantly further. And that would actually probably be a very, very healthy thing, technically speaking. Okay, not everything can go up forever. Looking at SPUT, SPUT has been chopping for the last couple of weeks, had a couple of down days. Right now, I would guess that we're probably at an 8 to 9% discount to NAV. If we go further risk off, we can see a little bit more downside here, but in our estimation, this is an absolutely phenomenal risk reward or risk adjusted proposition here. The downside is minimal. The spot bottom is basically in. There's a floor here. Anytime we dip down below like 72, buyers step in. And that is probably going to continue to happen if we see weakness further. So this is an unbelievable proposition here as far as we can tell. And risk adjusted, right? This is not like an explorer stock that makes a juicy hit with a drill bit during a bull market that can go 2, 3, 4x, right? We're talking about 5, 10% downside potential from here for SPUT with an upside of what? 50 to 100%. I think that's an incredibly strong prospect. URA against the S&P obviously has gotten hit over the past week or two. The fact that we outperformed significantly for multiple months while the S&P was going to all-time highs again is pretty noteworthy. Similar levels of resistance. This is going to make a higher low. Are we going to see this come down to the 200-day or even potentially gap fill? I don't know. I don't have a crystal ball. But eventually, we're going to see this expand dramatically and break up and out of this resistance that we've seen twice over the last 3 or 4 years. URA against the spot price of uranium, man, we've had a good run since April, a very, very sharp run, having a decent pullback here, not a whole lot of technical support, maybe a little bit down here, about 0.47-ish. We could see another few percentage points down. In fact, we could see it come all the way back down here to previous resistance from later part of last year. This will make a higher low, and I really, really would love to see a December 2020 to November 2021 type of move for this. So if we pull back here, excuse me, here we go. December 2020, November 2021, massive, massive rally for the equities against the spot price. I think we're in the infancy of a very, very large move for this chart. And then lastly, charting the commodity itself, which I don't often really do or put a lot of weight into. But hey, looks pretty constructive. We made a higher low after it pulled back from Sputs buying. That's good. We found support at perfect previous resistance, which is absolutely uncanny considering this is not a stock that technical traders are trading. This is a commodity that end users are buying to fuel a nuclear reactor. So very interesting to see that technically play out. Starting to recover here. Maybe we see a little bit longer in this 70 to 75 range, but this is going to blast through 80 and head higher, probably by the end of the year. Okay, that went significantly longer than I planned. Hopefully, that was helpful for you to understand some of the dynamics in the term contracting market and what we have ahead of us. Thank you so much. I really appreciate your time and your attention. I know this was somewhat of a long episode. Do hope to see you again soon. We'll be traveling soon, heading to London for the World Nuclear Symposium. Very much looking forward to all of my meetings there, connecting with some of you guys as well, and look forward to reporting back. We'll probably see you next month. So take care, be well, and thank you again for everything. Cheers.